February report I have sent to you. Here I just wish to tell you how important the volatility is for trend forecast. I'm sure all of you would have got this report. All of you must probably downloaded this report from our website. So look into today's price action. This is very important. This is last Friday we have given. And this is the price action shown by the Nifty. Opened up at 8828. Low, morning itself, this low has come. High 8881.3. So this is the highest point of the day. And you can find out the 0.5 level of our calculation was 8882.71, means 8881.3 it has achieved. We have calculated 82.71. So the close proximity of these calculations says the truth of this particular method. And this is not only a method, the volatilities, how important the volatility is, you can judge from here. Similar action you can see in the Bank Nifty also. So Bank Nifty also, that Bank Nifty price points, if I can go, you can find it out very well here. The day's high of the Bank Nifty 20,689.8 we got, and we have calculated the 0.5 level is 20,691.6. Only just 1 to 2 points below that we have achieved as per the day's high. And these calculations not only holding good for this week, from the past 70 weeks this particular reports are being given, and out of that 70 weeks, 64 weeks it has given you the success. The successful trend forecast of these two indices we have given from the past 70 weeks, out of which 64 weeks it has given the success. So this is the truth of the volatility. This is the reason why this volatility I used to integrate in all the analysis for better trend forecast. Today, two different techniques of intraday trading you are going to learn. These two techniques are part of our 34 intraday trading technique. So any one of you, if you are having my book on W.D. Gans method, in W.D. Gans method book I have given 34 intraday trading technique. Out of that 34 techniques, these two techniques also figure in that. So intraday trade using volatility, also intraday trade using the midpoint method. So these two things you are going to learn today. And in volatility method, what we are doing, we have to calculate the daily volatility from the past 10 days data. So this is the simplest way. Historic data we are taking, from there we will calculate the volatility. We need to calculate the expected price range from the daily volatility. Then we have to identify the trend as per the Fibonacci Gann or Elliott principle, and trade entry and exit. These are the 4 steps processes involved. So I need to just start working on that same concept. So earlier videos, if you have seen, there I have taken some 10 days data and I was just calculating. Here I have just taken 11 days data. So I'll get 10 records just to refine this particular method one step ahead. I've just changed a little bit here. I've taken 11 days data so that I can get 10 data here. So while doing these calculations, it is very quite easy if you are doing with the historic volatility. So this process involves this following steps. You have to use the logarithmic function ln of the current price divided by the previous day's price. So this is what you have to do. ln parameter. Once you get this value, copy and paste it in all cells. So you will get the ln parameter. You have to take the square of this value. So there is a cap symbol is available here and square, or the double multiple you have to take. Just copy and paste it. You will get all the data here. After getting these two things, you need the average of that thing. So one simple Excel sheet can solve your issues. So average function is there. Just drag it from the top to bottom. You will get the average. And here too also you have to, same way you have to calculate the average. So just drag it from the top to bottom. So 10 records, whatever the calculations we have got, so that average you calculate. Once you get this average, the next step is you have to calculate the variance. So variance of is a statistical term. So whatever the average you have calculated, from there you have to calculate the variance, volatility and price range. So these three things I am going to calculate here. So variance, the square sums. So this is square absolute return. In mathematical term, it is absolute return. So whatever the square part in the column D, endpoint, whatever the value you have got, this one minus the C column, average, whatever you have get. So that you have to take a cap symbol and 2. So you got the variance. Once you get a variance, and once you get the average out, then volatility is quite easy. Just take the square root of the variance. This is the calculation of volatility through historic data. So this is the daily volatility. This is known as your daily volatility. If you want yearly volatility, you have to multiply this thing with the square root of 365. This is the yearly volatility. Multiply it with 100 to get the percentage term. So yearly volatility comes to 6.84%. Daily volatility 0.0035. So if you multiply it with 100, you will get 0.35. I don't want to multiply with 100. I just want the price range. So 17th February, whatever the price you have ended, just in that price, multiply this one, the daily volatility, you get the price range. Once you get the price range on your table, then all remaining calculations are quite easy for you. Once you get the price range on your table, so remaining calculations are quite easy. So you have to use the Fibonacci proportion here and Fibonacci ratios. Most of you will be knowing 0.236, 0.382, 0.5, 0.678, 0.786. These are the Fibonacci ratios. So take the help of these Fibonacci ratios, multiply with the price range what you have derived, add it with the last traded price 8826 to get the uptrend, and subtract it from 8826 to get the downtrend. So this is how you got the uptrend, downtrend and volatility. So you have got the volatility through the process of logarithmic and square logarithmic calculation. Variance you have calculated volatility, you have calculated price range. Once this price range is there, it is quite easy. You have to multiply with the Fibonacci ratios, 0.236, 0.382, 0.5, these are the Fibonacci ratios. I'm just multiplying with the price range, so I will get the respective Fibonacci retracement price ranges. So now I will start my calculation from 8826 on 17th February where the price stopped or the ended. So from there I got these calculations. The validity of this calculation is very important. So this is for 17th February you have taken. It is for next day, for 20th February. How valid it is, whether the trade is winning or not, that is a different aspect. Today's low 8810. This is one of your calculation, 0.5. Today's open Today's open price also will take it. So today's open price will also take it. Today you have opened at 8828 and this is 8881.30. So this is what you got. So you have opened at 8828 in between this range, middle low, could not able to penetrate below, bounce back, touched here 33. So then your trend continues and you made a high of 8881.3. So this is expanded ratio 2 for the Fibonacci. Fibonacci ratio till 1.618. These three ratios 1.236, 1.618 and 2 are known as the expanded Fibonacci ratio. So 0.888 till this point you can say it is retracement ratio. So if you look into these values and closing also 8878. So the day's low, day's high, closing, these 3 points are closely coinciding with your calculation, which you have done as for the previous day's closing, 17th February. So now let us move to the next. So this is the thing we have done. And what is the next? So once I want to do the next, so I'll just copy these things here and one data will go out of my reading. So this is, I need this date to be changed, 20th February. So 20th February where we have entered 8878.4. So I just want that 8878.4. So these changes we have made. So once I made these particular changes, I will get the next readings. So tomorrow what will be the values for that? So this is the calculation I am getting for tomorrow. So now point is how to trade using these levels. So many of you will be, if you are using the Fibonacci technique is a well-known indicator for most of the traders. Many of the traders will be knowing the process of using the Fibonacci. Only thing here, instead of deriving the price range from a high and a low difference, I have taken the price range derivations from a volatility. That is what I have changed. So now, once you are following the Fibonacci principle, how you should trade. So you need to understand Fibonacci very carefully. So 0.236 price range, this sets the trend. This sets the trend and 0.382 confirms your trend. So this setting of trend and confirmation of trend is very important. So here this sets the trend and this confirms the trend. Confirms the trend. Once the trend is confirmed, you are going to be a buyer or a seller, whichever the direction the trend give you the confirmation. But one thing you have to keep in mind, try to hedge it. If you are buying at 8890, nothing wrong if you can hedge it at 8900. This is the best practice. Yes, a part of profit will be get sacrificed if the stop loss, if the target hits completely. However, if the stop loss hits, a part of loss also can be recovered. So this is why we used to hedge the trade. So hedging is a best practice. So once you buy a future, if you do not understand the complexity of hedging, if you buy a future, so the simplest way to hedge it, nearest to that future buy entry, you buy a put option. Put option. So this is, if you are buying a future, buy a put option of nearest strike. Same way, if you are selling a future, you must buy a call option of the nearest strike, nearest to your trend confirmation points. So, and in Fibonacci, 0.618 to 0.786 known as the death zone, means most of the trend reversal happens from there. So death zone doesn't mean that the counter will die down. The death zone means after touching this 8902, it is having all probability for the trend to reverse that. So if you are having a multiple lots of the trade you have initiated, try to book some profit and come out here. Or else, once you are in the 0.618 to 0.786 range, try to write some options above 8940, say 8950 or 9000. So that what will happen, even though that reversal happened, trend change happened, or the death zone penetration could not be fulfilled, if the price again fall back, you will get some chances to speculate. Means I used to tell, if you are buying at 8890 along with an 8900 put option and you have achieved 8902, though in future terms it is a very less profit, only 10 to 12 points of profit you have made. However, at that particular time, if you are selling one 9000 call option which is above your 8940 and holding into the trade, suppose trade reverses gone to 8890 again, so you can book the profit in the selling side of the options and come out. So this is how you should do some wise speculations. So the speculations is good, but if it is done in a very wise manner, it yields a profit. And if you do the speculations in a wrong way, then it always gives the pain, always gives results into the losses. So this is how you should utilize the volatility along with the Fibonacci to do the trade. However, this volatility calculations what you have done, it is just as per the previous 10 days data. This is not a real-time volatility. This is not the real-time volatility. On that particular day, because you have taken till 20th of February and done this calculation. However, on the day of 21st February, on the day of 21st February, many things would have changed. In the opening basis, something would have changed. In prices would have moved to a great swing over a period of 1 hour or half an hour. So that particular day's action is not counted here. Hence, this method of your historic volatility calculation has that limitation that it is just taken from the historic facts, so it has some limited accuracy. But when you are using our software, it takes the real-time volatility into account. So henceforth, its level of accuracy is different. Its level of accuracy is entirely different. So if you just take the same readings here, if I'm taking for volatility, so here what you are getting, 8878 till 8936, just compare it here. 8936. So here 40 you are getting, 8816 you are getting. So last target. However, I am just giving you 3654. So slightly changes are there. So this is based on the real time factor. So real time factor, and it has a lot of, we have a summary window, how many suggest buy, how many neutral, how many suggest sell. So some other studies you can get in that. So this is the difference when we say you about the volatility technique, and when it is programmed in the software, it has, this is the difference. Here the technique you are learning from the very basic, you are learning how historically you can calculate and utilize this. Nothing wrong if you can utilize this. And it will also give you one good accuracy. So 50 to 60% of accuracy you can enjoy in this particular method. However, when this same concept is implemented in the software, its accuracy level little enhanced because of its real-time nature of calculation of volatility. So this is one of the method of doing the intraday trade as for the volatility. Coming to the next method. So next method I have told you, midpoint method. This is also one of our 34 intraday trading technique. So here midpoint method is very simple method. Just you need to little, it is just a enhanced addition of your pivot point, you can say. But here I have utilized the GANs concept in that. So what it does here, you need three prices, base high, base low, and the midpoint. Midpoint is nothing but high plus low divided by 2. So this is the midpoint. So the mid of this high and the low, high plus low divided by 2, once you make it, it will get the midpoint. So once you get the midpoint, from the midpoint to high or from the midpoint to low, how many points are there? How many price points are there from mid? So this is, if you say this is the high and this is the low and this is the midpoint. So from midpoint to high or from midpoint to low, how many price points difference you have? Say 33. In this particular example, it is coming to 33. 8,207, 8141, midpoint is 8174. I'm just taking the difference, 33 point. So in the Gann's cycle theory, as per the WD Gann's cycle theory, so we have a formula to calculate the trend termination price rate. So I am just taking the square root of this number 33 added with 360 degree factor, so which is nothing but 360 divided by 180. Nothing to, it's not important to go deep into how this 360 divided by 185 I am making it. It is a concept of WD gap. So just 360 divided by 180, it is coming to 2. So square root of 33 plus 2. So this entire thing I have to take a square. So 2 times I am just making the same thing, multiplying, getting 60 points, 59.97. Once I get this 59.97, I will be calculating the uptrend terminations. From midpoint, I will be adding this one to get uptrend termination. Same way from midpoint, I will be subtracting this thing to get the downtrend termination. So these two termination price points I got. So I have to buy once the price move above 8174, and it should be below that high plus midpoint divided by 2. In between this range, I should buy, and I should sell once the price is fall below 8174. And midpoint will always act as a stop loss for me. Midpoint will always act as a stop loss for me. And the uptrend targets, I will be calculating high, that is 8207, plus midpoint 8174 divided by 2. So once you are buying, you should be buying between 8174 to 8190, because this is your first target. Second target will be uptrend termination price point, which you have calculated 8234 added with the high divided by 2. And target 3 will be target 2, which is nothing but your 8220.5 plus the termination point 8234 divided by 2. So this is your first target, this is second, and this is third. Similar way, once you subtract, you will get the downtrend price point. So let me explain that same thing with one Excel. So here we have taken midpoint. So this is for 17th data I have taken. So 8872.4, 8800 close. This is 17th February data I have taken. You have to calculate and see that how far this calculation is true and how far it has come. So here I have taken the midpoint price range between the midpoint and high 8872 minus 8836. If I can show you here in Excel formula, you will be getting. So this is how I will be calculating the price range. So this is just a difference. Then I will be taking the termination price range. This is nothing but I am using this Excel formula. So power, because I required a square root, I required a square. So I am taking the square root of this 36 points what I have got, added with 2. 2 is nothing but 360 divided by 2. This is coming from Gann's cycle theory. And I have taken square, so I got 64 points. So adding it with the midpoint and subtracting it from the midpoint, I got 8,900 and 8772 at the termination price point for this particular cycle. So this method says that every trend is a cycle. Every cycle is having a particular demand and supply situation. So this cycle, which is there from 8,900 to 8,772, is a cycle wherein between these particular price range you have a fixed demand and supply situation. This is what this method says. And thereafter we have to make an entry. So midpoint added with the high, whatever the day's high happened on 17. So divided by 2. So here telling you need to purchase between 8836 to 8854. In between this range you have to purchase, and 8836 will be your stop loss. So once you buy it, this to also your first target. So once you buy it, your second, third target is important. And once you are going for second target is nothing but the termination point and high divided by 2. And third target is quite easy. So it will be the second target what you have got added with the termination divided by 2. So this particular, and same way you can take the low and the midpoint divided by 2. So between 8836 to 8818 you can sell. This two also your first target. Your second target will be the termination and low divided by 2. And third, whatever the second target you got and the termination divided by 2. So this is how you got 3 targets. However, one particular drawback in this particular method is there also. This particular method of midpoint works very good in a volatility condition of 15% above. If the annual volatility of that particular instrument is above 15%, then it works nicely. So whenever it falls below this 15%, it gives a very feeble result. Means till target 2 to penetrate, it becomes very difficult. But 15% and above volatility, once you go for that time, what happens? It perfectly reaches that target. And once this target 3 achieves, then you got a new high, you got a new low. So you need to recalculate and get a bigger cycle. So what happens? You start with a smaller cycle, it goes to a further bigger cycle. In more volatility condition, it becomes further bigger. So this method gives you excellent result if the volatility goes up and down with a minimum band of 15%. So 15% above, this particular method gives wonderful result. However, when you go for a lower volatility band, this method gives you moderate result. So here the target 2 point becomes very difficult point for that counter to penetrate. As you experience here, so here target 2 didn't come, and downside also target 2 didn't come. So this target points become difficult in low volatility scenario. However, in the volatility technique, when you use the volatility and Fibonacci, it works wonderful in the low volatility scenario. And in the medium volatility scenario, when we say the volatility is above 20% and below 40%, so in this particular band, instead of Fibonacci, if we can utilize the GAN concept along with the volatility, it gives better success. And above 40% of annual volatility, when it maintains, Elliott's concept, if we can utilize with this particular price range calculations, will same. Only the concept of calculation of trend will change, so it gives better result. But consistently also you can utilize this Fibonacci principle along with this volatility. If you do not want to make it more complex, consistently you can make it like this. The main aim of this particular event is you must learn some of the valid concept of trade. So far, how do you trade for intraday trade? If I ask a common question, how do you trade in nowadays, or the majority of the trader, how they trade in stock market? especially intraday or investment or any kind of things. They listen to the TV channel, they buy some tips, and majority never use any method. They think there is no such method to calculate the future projection of the market movement. There is no such method available. So majority of the trader never use any method, and only 10 to 15% of the traders, they use the technical concept like your chart graphs, moving average, oscillator, indicator, etc. Only 10 to 15%. And some of the people, though they use specific method, but they're not consistent on that. So today they use certain method, tomorrow they change over to other method, very next day they change over to other method. Like this way they go on shifting the method of their trend forecast. And many times they never follow the calculation. Whatever the calculations comes, it is just pen and paper. But while exiting the trade, while booking loss in the trade, while booking profit in the trade, they never follow anything. So they never follow anything. So that is what the most pathetic nature of the trader's life. Any method you use stochastic, you use RSI, you use MACD, you use volatility method, or you use any kind of method, but must use it, and you must follow that things consistently. Without following the method, no one has got the success in the market. Without following any method, no one has got the success in the market. That is a fact and truth. Either you have to accept it today or you have to accept it tomorrow. But you have to use certain methods. And when you use any particular method, just compare with 2 to 3 methods. Whether this method gives you the proper success, whether these calculations, what you have done, whether it is really happening on the price in front. The price time chart, whether that particular price is coming on closing basis, on opening basis, or on the day's high, day's low basis, whether it is coming or not, that is the best indicator. We can do any kind of calculation. You can add certain things, subtract certain things, do any kind of calculations. Nothing wrong in that. Because all these things is just you have got a bunch of price points, whether it is the last traded price or day's high or day's low or whatever may be, you just got a bunch of price points. Using these price points, you can have moving averages, you can calculate oscillators, indicators, any kind of things you can calculate. Or calculate the methods what I am advocating. Calculate the volatility method. However, after doing this particular calculation, you must revalidate whether this calculation what I have done, whether it has really happened on the chart, really it has worked on the chart or not. If it doesn't work, then it must be having some lacking. It must be having some lacking. If it doesn't work, doesn't perform, definitely it has some lacking. So after all, the end result is the profit. What I got it in my balance sheet. The number of ways what I have followed, the number of softwares what I have bought, number of trades what I did, it doesn't have any value. End of the day, my success on the trade is only countable. I have started with X amount. Whether I am X plus or I am X minus. So this is the only truth you can see in your trade. So once the end result is just defined as per your success in the trade, you must evaluate every technique instead of asking each service provider how much success is your software, how much success percentage your tips is giving. You must you must evaluate it and see how whether it is happening. I made a calculation. I made a calculation as per moving average, oscillator, volatility, or any kind of method. Whether this calculation is obliged by the market, whether market demand supply situation obliges this or not. That is important. So when I talk about volatility, many traders used to say that many traders, this is not a technique innovated today. This particular volatility, if you can find out in our YouTube channel, from the past 7 years, I'm just giving you this particular method. And I say that as per this historic estimation of the volatility, you can get 50 to 60% of the trade accuracy. So out of 100 trades, only 60 trades will give you the success. You must backtest it. This calculations is very simple. Just take some 10 days, 11 days data. You require 10 days data for calculations. Just take logarithmic. Punching ln is not a big task. Anyone can do it in Excel. Punching ln and these values, second record divided by first record, or just going through this video for a couple of times, you yourself can able to implement it. Take a square, take an average of whatever the calculation ln values you got, take the average of ln square values what you got. Then you have to calculate the variance, because this is essential for calculating volatility. That's why I am making it. It is not, if it is not required, I should not put it in the Excel sheet. So whatever the calculations you have done in the column D or the square ln values average minus the ln average value whole square or double multiple, you take it. So this will give you the variance. Square root of variance is volatility. Multiply with the last traded price, get the price range. Once you get the price range, multiply it with the Fibonacci ratios known to you. Add it with the last traded price of the previous day. Subtract it from the same last traded price of the previous day. Calculate these values. 0.236 sets the trend, 0.382 confirms the trend. Means once this confirmation comes either in the uptrend or downtrend direction, initiate the trade with a hedging. And 0.6182, 0.786, this level is required little strong vigilance, because most of the trend changes happen in this particular range. So once it enters this particular range, better to book profit, or if you do not want to book the profit, write some options above your 2% of retracement, then you can get the result. So by this process, start trading for couple of weeks, couple of months, and see how successful this method is. And midpoint method, it is quite easy. Just to take the midpoint of the high and low, provided volatility of that instrument should be above 15%. Midpoint, between midpoint and high, take some difference. What is the price range is there? Just use the GAN's formula, square root of this 36, added with 2 whole square, termination points, add it to midpoint, upside termination, downside termination. Then this is like your pivot point. You have to calculate the target 1, target 2 and target 3. So target 1 is nothing but midpoint and high divided by 2. Whatever the previous high is there, divided by 2. And target 2, whatever the termination, highest termination point you have calculated and what is the actual high, that divided by 2. Target 3 is what is the actual high and what is the target 2 you got, that divided by 2. Same way you try to subtract, means the midpoint and low divided by 2, the first target, and target 2 will be your termination point plus the actual low divided by 2, and target 3 will be your second target whatever you got and termination point divided by 2. So this is how you should do the midpoint. However, to use the midpoint, the volatility must be above 15%. Above 15%. So that is a must requirement for the midpoint finance. So many of you ask always whether smart finance into broking, smart finance into what kind of activities. So all our activities are confined to the research and analysis and to innovate new techniques of trading. I do repeat here, we are the only organization involved in this market to innovate new techniques. The midpoint method you have never heard in any book or any of the periodical. Volatility you have not got in any book or any periodical. We are not into broking, not having association with any broker. We are purely into the research and analysis, and our research and analysis is purely depend upon to identify new techniques of trading. So during these 3 days, you will learn many new techniques of trading. So tomorrow you are going to learn beta decoupling. Today you have learned midpoint volatility. All this is our own method of innovation. We have also reworked on the Bollinger RSI and other things. Whatever the Bollinger Band and RSI indicators you are using, we have reworked on that. We have not changed the formula of Bollinger or RSI. We have just put the parameter of volatility into it. And that has become more powerful. So this is the thing here. We never manipulate any method. The existing methods, how to enhance that existing methods for better accuracy. Those are the things you can get it in my book on technical analysis, Fibonacci, or futures and options. So we have 6 different publications on different subjects. So what are the things it covers? You can get it in that particular content here. You can also read a part of the book. So that is, you can just click here and read a part of that book. Whether the techniques explained here is different or it is the same. So you can read a part of this book here. 20% of the books are visible in the Google Books. You can read. And using this concept, we have innovated many software tools like one standard deviation reports you are seeing. Similar way, many different courses we have developed. So far we have 12 products. So all these 12 products having different pricings. If you want one standard deviation, it costs you 2,750. This is only a software. If you want option strategy, it comes with one book and one course, 14 hours course, it costs 10,500. Like this way, we have 12 products. But those who are taking this entire product at one basket, those who wish to learn completely about the market, so we give that one discount. So instead of, if individually you buy, it comes to some 47,000 and all, so you get it at 17,500. So many of the traders, they also need one trade guidance over a period of time. So here we just, through many years of working, we have just come to one formulated program structure. So here every month we teach you specific concepts. We give you some live market exposure on those concepts. You get access to the WhatsApp group to raise your concerns, and many other things are involved in that. So every month little things you start learning, start practicing, start interacting, and it is just a 1 year's program we have in this design. So any month you can join. Suppose if you are joining on March till Next February it will be there. So joining on April till next March it will be there. So this is how it is being designed. So once you enroll this program, so with all materials, it costs you 22,500. However, if you have already taken the material, many of you have already bought the material 17,500 when this program is announced. But then this is the fee structure, 8,000. However, those who have not taken any material or those who have not bought any stocks from us, physical stocks from us, so they are not eligible for this program because they do not have any stocks to land. So the periodicals, whatever is required, that is missing for that reason only. They are not eligible for that. Those who have already obtained this material 17,500 or those who have wish to join, they can join. Newly you can enroll, or if you have taken a full package, you can enroll. So this cost you 22,500. So this is a program also we have, and we have. If you want, no, I just take one concept, one software, work on that. No need to learn anything. So that too also you can opt for. You have, so different people have different choices. So if your choice is just to take a software, make use of that. You will get a user manual of the software, start using that concept and find out success in that. So this one standard deviation concept also, whatever the softwares you are getting, it is not hidden. It is every week it is given to you. Look into this calculation whether it is working or not. If it works, then you should obtain it. If it doesn't work, no need to follow this software. So any concept we have programmed, we have proved it. We have proved it, it works in the market. So it is a pure calculation. Nothing is there. Yes, tomorrow market will open here, it will go to this level. I know a method, I will not say it. We are not such kind of company. If there is a method, we will show it. This is the method. This is what we have calculated and this is what we have programmed in the software. So we are very transparent in that. So